Rate hikes are sending housing into a tailspin, according to Capital Economics. And according to Desjardins, the correction has begun, and they're expecting a 15% reduction in home values by the end of the year. And we're going to discuss what all this means and if it's actually going to cost you less to own a home a year from now than it is right now. Because one thing you have to pay attention to is that interest rates play a very large role in how much a home will cost you. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so welcome back. Today we are discussing two articles. The first from Capital Economics, which is suggesting that higher rates are sending the real estate market into a tailspin. And the second from Desjardins, which is suggesting that home prices could drop by as much as 15%. And I want to talk about the actual cost of owning a home, because it's not just the price you pay for the home, but the interest rate you pay as well that goes towards the total value that you actually end up paying for a house. So you have to keep that in mind, especially if you're thinking, hey, I'm going to hold off and make a decision later on because it seems like housing prices are going down, and you completely ignore the fact that interest rates are probably also going to go up, and therefore you make a decision that ultimately ends up costing you more money. But before I get into all the details on how that works, do me that favor, hit the subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our Race to 25,000 subscribers giveaway, where we are giving away $5,000 on July 1st. In order to enter that draw, all you have to do is subscribe to this channel and go to 360giveaway.ca and officially enter the draw. By the way, you also get additional entries if you share the contest on social media and if you follow me on Instagram. So again, 360giveaway.ca. Okay, so let's get into it. Let's discuss what's going on in the Canadian housing market. There's two articles in the last couple of days that are very interesting. The first being from Capital Economics, and that is this one: rate hikes risk sending housing into a tailspin. And this is a really interesting article from the perspective of the fact that it talks about how high interest rates could go and the fact that the Bank of Canada is seemingly ignoring the housing market with respect to their intent to reduce inflation. So in other words, what they have suggested is that they don't care how much housing market sales go down. They don't care how much housing values go down, as long as they are getting towards that lower number of inflation. And there's a couple things here with respect to this conversation, because first and foremost, yes, the Bank of Canada has to do something. And the first piece, the first domino that is going to fall in this whole inflation story is probably going to be real estate. And yes, we're going to see a correction, but not necessarily in every market. The markets that have gone up significantly in value, like the Maritimes and areas like just outside of Toronto that benefited hugely from the work from home policies, are probably going to feel the most pain. But if you look to the prairie provinces right now that are benefiting from a commodities boom, well, those markets are still probably going to be okay, because obviously the markets there are very much commodity dependent. And we're seeing this in Calgary as other markets are falling and sales are falling. Calgary is setting new record sales numbers, and it is absolutely ridiculous in this market because people are less sensitive to interest rates when the economy is really, really good. And the economy in Alberta right now is very good because of higher oil prices. Now, what Capital Economics is also suggesting is that there is an extent where the Bank of Canada is going to have to pull back on this, because if they absolutely collapse the Canadian real estate market, well, that's going to have a pretty significant impact on Canadians, and it is going to be a recessionary pressure that they're eventually going to have to deal with. So it's going to be really interesting over the next few months to see what happens as the Bank of Canada increases rates even further and further and further, and to see what effect it has, because the case very well could be made that sometime in late 2022, they realize they've gone too far and they have to turn and lower interest rates again, but only time will tell. I mean, we didn't think we were going to be here in April of 2021 when the Bank of Canada was suggesting that interest rates were going to remain low well into 2023. And who knows where we're going to be 6 months to a year down the road when the Bank of Canada is suggesting that they're probably going to continue raising interest rates well into 2023. So who knows what's going to happen. But what's really interesting here is now we're ending up in this scenario where people are trying to time the market. And they're trying to wait for housing prices to come down because they think that they're going to get a deal at some point. And Desjardins came out this week and said the housing market correction has begun, and they're expecting a 15% decline in housing prices. Now, here's the thing. There's going to be certain markets that have declines, and there's going to be certain markets that don't. And like I said, if you're in that Maritime area, if you're in that outside of Toronto area, you're probably going to have bigger declines than other areas of the country. But the question is, when do you jump into the market? Well, we've always suggested that you jump into the market at the point where you can afford to do so and where you expect that you can reasonably make payments for the long term. But here's the thing, if you're thinking I'm going to wait till the end of 2022 in order to get a 15% discount on home prices, well, if you're in that Toronto area, Toronto's already seen a 9% decrease off of their highs in February. So if you're using the Desjardins metric and you're assuming that housing prices are going to go down by 15%, well, you've only got 6% to go. And that's where the conversation gets really, really interesting, because now what you're doing is you're waiting for a further 6% slide in housing prices. But you're doing so while interest rates continue to go up, and 5-year fixed rates are continuing to go up every single day here. So if we go ahead and we take a look at what a 6% reduction in housing prices would look like compared to a 1% interest rate increase, well, the numbers get really, really interesting. So what I want to show you is a simple mortgage calculator. You can get this calculator by going to the link in the description below, and we're going to make some assumptions. So we're going to make the assumption that if you buy now versus buy later, that the interest rate is going to remain the same for the entire amortization. I know that you can't really do that because obviously there's ebbs and flows in interest rates, but I think it's a safe assumption if we're holding all else equal here so that we can see and illustrate what a 1% interest rate increase would look like compared to a 6% drop in real estate prices. So what we're going to do is we're going to jump into the calculator here, and we are going to take a look at what a 6% reduction in prices would look like compared to a 1% increase in interest rates. So this is really simple, and you can do this for yourself. You can figure out what amount of reduction you want to calculate versus increase in interest rates. You can play with the variables yourself, but let's just take a look here. So we're going to start at a 4% interest rate, which you can get a 3-year or a 4-year or a 5-year mortgage today for that amount. That those rates are going to go up. But if we go and we take a look at this and we look at the total paid over the life of the mortgage, we are going to pay in total for this house, $500,000 mortgage. We're going to pay $791,000 for this mortgage. Now, let's say we get a 6% reduction in housing prices, and this goes down to a $470,000 mortgage, and we increase the number to 5%, so a 5% increase in interest rates. Now we're paying $824,000 for this property. So we are paying significantly more. Even though we got a 6% price reduction, we're going to end up paying significantly more in total for the property because that higher interest rate more than offsets the reduction in price. So a lot of people are leaning towards not jumping into the market right now. They're going, I want to wait for that price reduction because I'm going to get a way better deal, but they're not factoring in the interest rate. And the interest rate can be one of the single biggest costs when it comes to that mortgage and the overall cost that you end up paying. Now, of course, like I said, we're keeping all else equal here, and we're assuming that there's going to be a 1% interest rate difference in that mortgage for the entire life of the mortgage. But I think what you need to realize here and what the understanding needs to be is that waiting may not be the best option. And right now, because housing prices are going down, people are getting fearful, there's an opportunity to buy into the market right now and get a deal. And if we go back and we take a look at this Desjardins article, one of the things that they point out here is that they do not expect that housing prices are going to get back to where they were pre-pandemic. So if you can get a really good deal this year while also securing a really low interest rate, and in this case, we're talking about 4%, not 2% anymore, well, there could be an opportunity to buy. Now, could the opposite happen here? Could interest rates go down? Yes, absolutely. Could housing prices drop significantly more? Yes, absolutely. Could they turn around and go up significantly? Yes. There's a whole bunch of unknowns here, and this is why we always say that the best time to get into the real estate market is when you can afford it and you can get a mortgage that you know that you're going to be able to pay for the long term. And like I've always said, short-term decisions are what get people in trouble. So trying to time the market for that 1 or 2% reduction in housing prices is the thing that typically causes people to stay out of the market like they did in June of 2020 and wait until such time as the prices get too high. And by the way, most people can't time the top of the market when it comes to stocks or real estate or anything else. So if you can't time the top of the market and get rich that way, what makes you think that you'll be able to time the bottom of the market and get a really good deal on a house? The opportunity right now is you're going to be able to get a better deal than you could in February, and that may be the best time for you to buy because you can also still get a reasonably low interest rate. And if interest rates go up, well, then you're going to end up doing pretty well. And if they stay the same, well, at least you got a house and a mortgage that you know that you can afford for the long term, and you didn't buy at the peak. By the way, if you're looking at getting into the housing market, we have a course called the First Time Homebuyer Bootcamp that takes you through everything you need to know in order to buy a property. We've also got our Secrets to Getting the Lowest Interest Rate course, which gives you all the information you need to get the absolute lowest rate from your bank or your broker or whoever you are dealing with. It also tells you all the things you need to avoid, all the landmines and surprises that can end up costing you tens of thousands of dollars. The link to both of those courses is in the description below. And if you get them both at the same time, you get an extra deal. So if you found this video useful, do me that favor, hit the subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.